right, welcome back, everybody. So now we're diving into chapter 7. Okay, this is the first half of chapter 7 where we're going to be looking at perpetual inventory purchases. Okay, so everything that you learned from chapter 5 and 6, I want you to put it in the back of your head because we're looking at the other half of inventory, right? We already looked at periodic inventory. Now, they have similar concepts, except there's a few things that are different between periodic and perpetual, right? We understand the definitions are different. We also will recognize the inventory as differently as well, okay? So again, for now, just go ahead and put that concept of chapter 5 and 6 in the back of your head, and let's focus on the newer material of what happens when we make perpetual inventory purchases. Okay? So once again, we already identified that we are a merchandising type of business, so we need to make purchases of inventory, okay? So what are the purchases of inventory? Well, our main goal is to take cash, purchase the goods, then we take the goods and we sell them and we convert it back into cash, okay? Again, we're looking into being a retail store or possibly a wholesale store, okay? So then in this case, right, what is included in the price of the cost of goods sold, right? We identified that the definition is going to be whatever cost it takes to get the asset to your store. So that means the cost of goods sold will include, obviously, the selling price, sales tax if you are subject to have to pay it, anything like freight expenses, expedited expenses, shipping and handling, especially if you have fragile items, right? Or even storage fees could possibly be part of the cost of your inventory. Right? So let's go ahead and dive into the two tracking methods. So again, we already discussed everything that we need to know about periodic inventory, okay? But what we don't know yet is we're going to be diving into the perpetual inventory and see what the real difference is and which one's more preferable, okay? So in this case, right, we already know everything we know about periodic. So perpetual, we understand this. Perpetual, if you look it up in the dictionary, right, it literally means constantly, right? So this kind of concept is, that means if you're constantly dealing with your inventory, that means you're constantly updating it. Every time you make a purchase, you update it. Every time you sell something, you update it. So at the end of the day, you don't necessarily need to take a physical account or a physical count of your inventory, because at the end of every transaction, you should know automatically how many items you should have left in inventory, okay? So think about any kind of retail store that you go to. They all have an automated system that tells them right away how many items that they have on hand and how many they have sold, and so on and so forth, right? That is a perpetual type of inventory tracking, where they can tell you right away by looking up in their system how many items they have on hand, how many they sold, how many they need to repurchase, and so on and so forth, right? But in this case, what I want you to see is how it differs when you're calculating the cost, which is chapter 8, and how we record it is also going to be different. So in this case, because we constantly know whether we do our inventory every day, every week, every month, you're constantly going to be knowing the ending inventory on hand at all times, okay? Physical inventory is just to ensure that, there's no mistakes going on. But in this case, right, here is the huge difference. When we purchase our inventory, we have to recognize that everything is going to go straight into inventory, okay? Okay? That's the huge difference. So instead of recognizing as an expense, right, which is periodic, for perpetual, we identify the items as inventory. And every single cost that's included into that inventory item is also going to go all straight to inventory. Okay? So let's go ahead and dive into our first example here, right? Perpetual inventory purchases. So here's your example, right? On July 1st, XYZ company purchased a total of 100 toys costing $5.65 each from Toys R You. Okay? And then they also had freight cost of $100. So let's go ahead and record this transaction. So again, if you remember the concept, right? Everything is going to go straight into inventory. Okay? So that means my purchase of inventory for $565 straight to inventory. Okay? My freight cost that I had that included with my inventory is going to go straight into inventory. So at the end of the day, I am actually going to be recording that I purchased $665 worth of inventory, and it's going to go straight into inventory. Okay? If you don't know what the item you purchased, then inventory, right? But if you know the specific item, like for example, I purchased 100 toys, go ahead and actually recognize the item that you are purchasing, right? So instead of in case for, again, instance, right? If you sell more than one item, right? Your best bet is that instead of shoving everything into inventory, right? You want to create sub-accounts to know what kind of items that you sell. So in this case, I'm being specific, saying everything is going to go into inventory - toys, okay? Now, why is everything going straight to inventory? Well, that's the thing. We don't need to separate the costs because at the end of the day, when we calculate it, we're including the price of everything that's included, right? Because we want to make sure that when we create our selling price, it includes everything so that we make the customer pay for all the cost it takes to get the inventory asset to the store. So we don't have to separate the cost for getting the items there. Yes.
So, in other words, we don't have to worry about LIFO, FIFO, and average method in perpetual.
Yes, we do, because that's going to be in chapter 8.
Oh, okay.
Okay, so remember, costing method is completely different from tracking method. Okay,
Okay.
in
All right.
tracking method, we don't need to separate our costs. Like, for example, we don't need to separate freight expense. We don't need to separate shipping and handling expense or sales tax expense, right? And in this case, we don't need to identify it. We just all shove it into one account. That's the only
Okay.
difference.
Thank you.
Yeah. All right. So, since everything's going to go straight to inventory, that is it for the first section of chapter 7. Any questions? Okay, so see, very straightforward, very easy. When you recognize perpetual inventory, everything's going to go straight to inventory, and that's all we need to know. Okay? So, of course, when we make purchases of inventory, that means we also have the capabilities of possibly having returns and allowances. So, purchase returns and allowances. So, let's go ahead and identify it because at the end of the day, right, what usually happens is that oftentimes, because we're buying in bulk from a vendor, right, there's a lot of things that can happen, such as damaged goods, right? Maybe they sent us the wrong items, or they're just defective items because you have to, I don't know, some people test their products, right? And they package them themselves. They test to see if the items even work, right? And then, of course, maybe it could be customer service, right? I don't like this person, or they might have outsourced to another vendor who sells the same quality, but it's much cheaper. There are many reasons why you would want to have a purchase returns, right? Because especially when you buy in bulk, maybe the product you're receiving isn't great, whatever reason, you have the capabilities to return the product, okay? Now, of course, as a vendor to customer relationship, right, because we are the purchaser, right, the vendors are going to want to do as much as they can to keep their products sold, right? So they will go on beyond and above and beyond because they realize that we are buying from them in bulk, right? Because we are a retail store, right? We are selling the product for them. Okay? They want to keep us in business because we're purchasing thousands and thousands and thousands of items from them. So they are going to do whatever it takes to keep our business. So they can offer special discounts. They can offer unlimited returns. They can even do unlimited exchanges and even money back guaranteed. Okay? So in this case, right, so let's take a look, right? Let's purchase our items first and then we'll return them, okay? So again, another practice here where on January 1st, okay, you made a purchase of 100 coffee mugs and they from Cuppy's Co. on an account, okay? And they cost you $1.25 each with a freight of $100. Record this transaction. So again, we're purchasing perpetual inventory. So that means we have our purchase price, we have our freight, so we calculate those two numbers together because everything's going to go straight to inventory. And how is that going to work out? We calculate what my 100 times $1.25 is. We add in the freight of $100. So now I'm looking at $225 that I am purchasing from Cuppy's Co. Okay? Everything goes straight into inventory. In this case, I purchased coffee mugs. Okay? So then, let's say on January 5th, right, you opened up your box and then when you received it, you found that 10 of those coffee mugs were broken. Okay? You can't sell those coffee mugs. So in this case, and you paid for those coffee mugs. So you go to the vendor and say, hey, I want to have a full refund on these broken coffee mugs. Okay? And of course, the vendor also says, okay, yes, they grant you the full refund. So how do we record this transaction? Well, we know this rule, right? This rule also stays, this rule also is still in contact, right? Saying that when you return a product, right, you can't return shipping, right? Everybody knows that. In this case, right, we have to understand that separate cost was to get those inventory items to my store, right? It doesn't include into the actual purchase price itself. So in this case, right, how much can I actually return? Well, what did I originally purchase each coffee mug at? I purchased it at $1.25. So in this case, how do I record that I am doing a full refund? Well, first let's think about it, right? We purchased it on an account, so that means we didn't pay for it, so we're going to get it refunded back to what we owe, right? Second thing is, where did we place our coffee mugs? Where did we place our inventory? We placed it into inventory, right? So therefore, how are we going to take it out from inventory? Well, straightforward. You're going to take it out from inventory. Okay, so here is we don't need to create any contra accounts or anything, right? Because all we need to know for this one is, okay, I put it into inventory, so if I need to take it out, I take it out from inventory. So that's the straightforward and easy concept that here we are going to learn is that since everything's going into inventory, that means everything's going to be taken out from inventory. All right, so in this case, accounts payable and coffee mugs. I'm going to credit coffee mugs because that's going to reduce my inventory account. I take my $10 times $1.25 and I get $12.50, and that's how much money I am getting back. All right? Easy enough? Okay. And of course, because of the whole vendor and to customer relationship, especially when we're purchasing inventory, for this example here, so separate from the previous one. Let's say on January 5th, we received the items and opened it up and realized that 25 of those coffee mugs were the wrong size, okay? And of course, you requested for a full refund, but the vendor was able to convince you saying there's nothing wrong with these coffee mugs, right? They are in good condition. You could still sell them at the end of the day, right? And because we made a mistake, we'll offer you a discount, okay? We'll give you an additional discount for 20% off because we sent you the wrong items. But they still convince you to keep the items at the end of the day because they're right. You could still sell the items. There's nothing wrong with the inventory, right? These cups are just the wrong size. They're the extra large instead of the regular size. So in this case, they said, you know what? We'll give you a 20% discount because we want to say sorry for sending you the wrong items. Okay? So instead of you having to ship it back or get your money back, right? You could still keep the items to keep selling it in your store. So in this case, again, you're going to recognize the accounts payable because this will definitely go against your bill. And where are you going to take it out from? Well, you paid full price for all 100 coffee mugs, right? But 75 of them are correct, where you're getting 25 of them at a discounted price. So in this case, once again, where did I put all my items? Well, I placed them all into inventory. So what are we going to do? We're going to take it out from inventory, right? Because I paid 25 of these at a discounted price, but I originally recorded as full price. So that's why I got to take it out of my inventory, right? So in this case, I got to figure out what my discount is. Well, 25 times $1.25 gives you $31.25. I can only take a discount on what I am returning. Okay, so that's what an allowance is. I'm only getting a portion of the refund. So in this case, right, what's 20% of $31.50? You get $6.25. So essentially you get like two or three coffee mugs free. Okay? All right. Any questions in regards to purchase returns and allowances? No? All right. That's it for 7.2, right? Yes, anyway, so as you can see, perpetual inventory seems to be a lot more easier, right? You don't have to come up with all these extra contra accounts, contra accounts. You're only dealing with one account and one account only. So if you're putting everything in inventory, you're taking everything out of inventory. So that's the same concept here when we are dealing with perpetual inventory, especially when we're dealing with purchasing and returns and including discounts. So what happens when we get a purchase discount, right? Because at the end of the day, a vendor can offer you an opportunity to take an additional discount, but they have to give you terms. Terms is a condition where they say, hey, if you pay me within a certain amount of days, I will grant you a discount, okay? If not, I'm going to give you that your full bill is going to be due in X amount of days. So that's exactly how we read terms, right? This is a 2% discount if you pay within 15 days. If not, the entire bill is due in 30 days. So this is an incentive for, number one, to speed up the process to get your money quicker. But also, again, especially when you're buying in bulk, taking advantage of a discount is probably something that you definitely want to do because, again, if you get to pay less for what you purchase, that gives you a better opportunity to charge a higher price to make more profit. Okay? So again, but at the end of the day, right, it all comes down to, do you have enough money to pay, especially when you're buying in bulk? You're spending thousands and thousands of dollars. Okay? So that's what terms are. Now, terms, again, there are two ways we can record this, right? So this also applies to perpetual inventory as well. The only difference is how we journalize it, right? Because with periodic, we have a whole completely different system where perpetual is also is the same idea but different accounts. So in this case, right, net method, we understand, right? Just like a paycheck is where you take the discount out already and you record it at the discounted price. While gross, you wait till you pay it, and then if you pay within the terms, then you record the second one as redeeming the discount. Okay? So let's take a look at net method first, okay? So again, here for this example, we have February 1st. you decided to purchase 100 coffee mugs from Cuppy's Co. Um, again for $1.25, okay, with a freight of $100. Okay, and this time you were given terms of a 5% 10 net 30s. That means if you pay them within 10 days, they will grant you a 5% discount. If not, it is due in 30 days, the full bill. Okay, so let's go ahead and record this transaction using the perpetual method. So in this case, right, since we're going to be recording then using the net method, right, we understand that we purchased 100 mugs at $1.25. So because we're just going to say, hey, we're really good at paying our bills on time, we're going to automatically assume we're going to take the discount right away. Okay, so in this case, what is 5% of that $125? That's going to give you $6.25. And of course, we have to also include the freight. So in this case, that's exactly what we're going to recognize. We're going to recognize the discounted amount. So what we're going to have here is 118.75 plus $100 of freight to give you a grand total of $218.75. Okay? And of course, you pay for it on February 9th, which is within 10 days. So all you're going to do is you're going to pay for what you recorded that you owed, which is the $218.75. But what happens if you accidentally missed it? Well, then if you accidentally missed it, then you're going to have to take that discount and plug it back into your coffee mugs because you end up paying everything full price instead of taking the discount. Okay? No contra accounts necessary, right? You just have to recognize that, okay, well, I end up missing the discount. So that means I have to pay for the items at full price. Okay? Even though you recognized it at $218, you have to remember you need to add back that extra $6.25 back into the inventory and pay in full for the $225. Okay? And then, of course, gross. You already know why we've been practicing this, right? You just recognize it at full price, okay? And when you get the opportunity to pay, so in this case, I paid within 9 days and they gave me 10 days, then I recognize the discount, right? I don't put in purchase discount. I just take it out from my inventory right away for that $6.25. So therefore, I only pay $218.75 opposed to the $225 that you originally owed because you paid within the terms. So that means you should be paying less. Okay? And of course, if you miss the discount period, then you just pay for the amount in full. Okay? Straightforward. Any questions in regards to chapter 7, right? Yes.
So for perpetual, we don't get to see like total discount and such right away because it's all in the inventory account.
Yes.
Right. So in order for us to know the actual, say, if I'm curious how much total discount we got, we actually have to add all the discount we received by myself.
Well, in this case, right, this is only one aspect, right, of recording, right? Because you're going to have a description, obviously. So when you put the description, then you reveal that, oh, I got a 5% discount.
Yeah.
Okay? And then, of course, your second source of information is you're going to have the copy of the bill.
Yeah.
Okay? Yeah. But in this case, no, you don't actually physically see it. You don't have a special account for it. It's all going to be separated. Yes.
Okay. So that's the one major difference between perpetual and the periodic. Because periodic, they had it there. We had its own account to see the discount total throughout the period.
Now, if you really want to, you can create a main account that it says like inventory purchase discounts, right?
Okay.
And that would just fall under the category of or that would fall under the account type, just inventory, right? Because you can create sub accounts under it.
Yeah.
You can do that, but at the end of the day, you're still discounting your coffee mugs.
Yeah.
Yeah. If you choose to do so, you can. Again, that's just more clutter, more things, because again, this is actually mostly for the inventory manager.
Okay.
Mm-hmm. Yes.
All right. Thank you.
Mm-hmm.
Okay, I know this is probably down the road in another chapter,
Mm-hmm.
but if we're not recognizing freight separately,
Mm-hmm.
when we do our financial records,
Mm-hmm.
does that just not show up when you're using perpetual?
Well, in this case, right, we're basically combining all the costs into one account.
So we don't on our financial records and stuff that goes to tax things.
Mm-hmm.
Is that ever separated somewhere for the accountants, or do we not worry about that? Or
Well, you do have a choice, right? If you choose to recognize it, yes, you can create a sub account that's specifically just for freight expenses, but it's really unnecessary because at the end of the day, you're going to sell your inventory as a whole instead of separate, right? So
okay,
in
so
this
it doesn't
case,
affect
no.
taxes in any way.
You won't necessarily need to unless you want to.
Okay, I just everything seems to be going towards taxes, and I thought, okay, if we don't have the expense to buy it out,
Mm-hmm.
does that affect the tax situation? But if it doesn't, I won't worry about it.
Yes, in this case, no, because at the end of the day, right, who's covering all these costs? The customer is.
Right.
Mm-hmm.
Okay, thank you.
Mm-hmm. All right, so today we learned about perpetual inventory, how when we recognize and we actually purchase our inventory, we recognize them as the actual inventory item itself, and everything is just going to be placed into inventory, right? All expenses, so including sales tax, freight expense, all those expenses that are extra costs, they're all just going to go into the same account, inventory. Okay? Of course, we talked about the purchase returns and allowances, right? Again, since you put everything into inventory, that means when you recognize a refund, it's going to be taken out straight from inventory. Okay? So whether it's a full refund or whether it's a portion of the money, you're still going to recognize it as taking it out from inventory. Okay? Same thing with your discounts, whether you recognize it as a net method or a gross method, right? Right. The idea here is these are conditions you have to meet before you can be able to again recognize this discount, right? But at the end of the day, even if you do, they're all gonna either go into inventory or they're all gonna come out of inventory. Okay? That's the main key idea here. No need for any contra accounts or contra accounts. Okay, all we're dealing is with one account and one account only, and that's the inventory asset account, which is whatever item that you purchased. Okay, so same ideas, only difference is how you are journalizing it. Okay. So let's go quickly over the example or the exercise today, right? For the chapter 7.1 all the way to 7.3, okay? Perpetual inventory returns and allowances and discounts, okay? So in this case, on April 5th, we end up purchasing 1,000 units at $5 each with a freight cost of $100 on an account. Terms are 5%, 10 net 30. Right? So in this case, how do I record this? In this case, I'm not giving you a specific item. So in this case, how would I record that I made a purchase of inventory on an account?
Inventory, you would debit the 5,100.
Okay, so inventory, okay, for $5,100.
And then you bought it on account, so it would be accounts payable for the same 5,100.
Good. Okay. And of course, your description could be whatever you want. So in this case, I'm going to say that I purchased 1,000 units at $5 each. Okay, and of course, other piece of information I'm going to also include is I can take advantage of a 5% discount if I pay within 10 days. If not, the whole bill is due in 30. So 10 days. So what is 10 days from now?
15th.
15th. So that means if I pay within the 15th, I will take a 5% discount. If not, it's due in 30 days. So that means May 5th will be, May 5th will be the day that I have to pay this $5,100 in grand total. Okay. So then on April, yes.
Noting the flight cost of $100 is not a big deal.
You can if you want to, but I mean, you can if you want to. It's up to you. But in this case, what's more important is that I identify that I purchased 1,000 units at $5 each. It's up to you if you want to. Again, that's just more information.
Okay.
So that would just better your, when other people read your journals, that would just better their understanding. Mm-hmm. So then April 7th, right, we end up returning 200 damaged units for a full refund. So I end up returning 200 damaged units for a full refund.
Okay, you debit accounts payable.
Because we never paid.
Yeah, for the 200 times 5, so that's 1,000. And you credit inventory for the 1,000. And you make a note that you sent 200 back at $5 each.
Good, right? Return 200 broken units full at $5 each. Full refund. Okay. Now this refund obviously will not affect your bill because at the end of the day, you're still billed for all of it. It's just going to be reduced. Okay? So that means it's the vendor's responsibility to issue you a new invoice to recognize that they have credited your account. Okay? All right, so then April 10, I end up purchasing 750 units at $5.75 each with a freight of 75. Okay, on an account, terms are 5%, 10, net 30. So how do I record this purchase on April 10?
Okay, your inventory would be 4,387.50.
Mm-hmm.
And then your accounts payable would be the same, right?
Because we're including it all together. So for $4,387.50. Okay. And this time I purchased 750 units at $5.75 each. Again, 5%, 10, net 30. Oops, sorry. Okay. So then April 15, we end up returning 50 broken mugs, okay, due to shipment, okay, for a full refund. So I end up returning 50 broken units due to shipment.
Accounts payable is debited, how much does that have? $287.50. No, yes. because
Yes.
that's
Yeah, that's the good. That's
it
right.
threw me. And then inventory is credited that.
Yeah, so in this case, I'm going to go to my next page here because it pushed it down anyway. So, oh. Okay, and this was on April 15. Okay, so this time we returned 50 broken units for $5.75 each, with 75 for a full refund for $287.57 50 cents. 287.50. Okay. So then let's see what's next. April 20th, I end up purchasing 200 units for $6 each with a freight cost of $20 on an account. Terms are 5%, 10, net 30. Right? So in this case, what happened here, right? I end up purchasing 200 units at $6 each with a freight of 20. So what is going to be my journal? Will be the same thing.
Inventory would be $12.20
Mm-hmm.
and accounts payable the same.
Good, right? Okay, 12.20. Okay. So then April 22nd rolls around and 25 units were the wrong color, willing to accept a 20% discount. Okay, so in this case, 25 of those 200 units were the wrong color, willing to accept a 20% discount.
Okay, so accounts payable would be debited $120 because that's 20% of 25 by 6 or times 6. And then you credit inventory that same 120.
So, okay, so in this case, right? So we end up we had 25 of them that were the wrong color, right?
Right. At
At $6 each. Okay.
with a 20% discount.
Okay. So how much are you actually refunding?
120.
That's what you're charging. That's what so after the discount, right? That means I only paid 120 for those 25 items.
We're refunding 30.
Yes, good job. There you go. $30 is what we're refunding. That means I paid for those 25 units. I only paid 120 opposed to 150. So in this case, I'm going to get refunded $30 back. So in this case, allowance for 25 units at $6 each. Wrong. Color for 20% discount. Okay? For $30. Okay? And then let's see, lastly, on April 25th, we end up purchasing 500 units at $6.25 each with a freight of 50. And of course, on an account terms, 5% 10, net 30. So once again, same thing, same journal entry, only difference is we're recognizing different numbers. Okay. So this is April 25th. We purchased 500 units at $6.25 each. Right? So in this case, what's my total inventory with a freight of $50?
$31.75.
$31.75. Right? It'd be $31.25 plus $50 of freight will give you $31.75. Okay? All right. Last but not least, on April 30th, you made a payment for all 4 purchases, okay? Write 4 separate checks, okay? So let's look at the very first purchase that we made, okay? First purchase that we made was on April 5th, right? We purchased 1,000 units on an account. However, on April 7, we end up returning 200 units for a full refund, okay? So let's see. So we originally purchased $5,100 and we end up getting a refund for $1,000. So how much do I actually owe for this purchase here? $4,100. Now, let's take a look because we also were given terms. If I'm paying as of April 30th, right? Did I meet the discount due date?
No.
No. So I end up missing the discount opportunity. So that means I am just going to pay for my purchases I made in full. Okay, so April 30th, right? How do I recognize I'm paying for what I owe?
You would debit account payable
Good, right? Because I'm paying for what I owe.
and credit checking.
Yes, because we wrote a check out. We wrote a check, right? So in this case, because I have to pay in full and we recognize what we actually owe $4,100. Right? We originally purchased 5,100. We returned 1,000. So that means I only owe $4,100. And what I'm going to say is, well, I'm making a payment to, did I specify who I made a payment to? No. So in this case, I'm going to recognize that payment for purchases made on April 5th. Okay? That's, oh, and then of course, I wrote check number 1. This is my first check. Okay? So then let's go ahead and identify my second batch of inventory. I purchased right here on April 10, 750 units, but I end up returning 50 of them. Okay, so let's take a look here. Okay, so when I originally purchased the 750 units, it cost me $4,387.50. But because I end up making a refund because they were broken, I end up receiving a refund for $287.50. So how much do I actually owe this place?
Did we meet any of the terms?
Well, let's see. 5%, 10, net 30.
We didn't, so it would be 4,100.
Good, right? So in this case, no, we end up missing the discount once again because if it was in 10 days, I had to pay by April 20th, and I did not. I'm paying as of April 30th. So in this case, I did pay within the billing date, but I end up missing the opportunity for the discount. So in this case, I have to pay in full, right? If I started out with $43.87.50 minus $287.50, I owe another $4,100. So in this case, okay, I'm going to copy this exact transaction because this is identical, right? Only difference is this purchase was made on April 10. And this is my second check I wrote. Okay. So then let's see what happened next. Okay, or which batch of inventory I purchased next. So then the next one was on April 20th. I ended up purchasing 200 units at $6 each. Okay, but I end up getting a discount on 25 of them. Okay, on April 22nd. So let's take a look at that again. Okay, so here's my purchase on April 20th, right? I purchased a total of $220. I'm sorry, $12.20, okay, for the 200 units at $6. But I end up refunding or getting a discount for $30. So how much do I actually owe now?
You owe $11.90.
$11.90.
Is that within the 10 days though now?
Well, let's see. Let's see. What's 10 days from April 20th?
The 30th.
The 30th. And when am I paying?
The 30th.
We're paying on the 30th. So now we recognize we have a discount. Okay? So this time, how am I going to journalize this discount? Okay, so first let's recognize, well, we're paying for what we owe, right? How much do I owe as of right now?
$11.90.
$11.90, right? The $12.20 minus 30 because I got a discount for those 25 items, right? So that means I owe $11.90 right now. Okay? I'm obviously going to pay, but the difference is I have to also recognize my discount. So where is my discount going to go?
So you would need to credit the $59.50 for the discount. And what would that be? Purchase discount? Is that what it comes out of?
So that's for periodic inventory.
Yeah, that's what I'm not. I'm
Well, what?
looking through my notes. I can't see what you called it.
Well, where do we put all our inventory?
In inventory.
So where do I have to take it out now?
Come out of inventory.
Everything comes out of inventory. Good. So that means I got to take that discount right out of inventory and then I have to pay. Okay? Right. So in this case, right, how much is my discount? You said it was $59.
$59.50 is 5%.
Okay. Now, how did you figure that number out?
Oh, I did. Well, the discount. I took it right off of the 11.90
Right. What does the 11.90 include?
freight.
It includes the freight. So in this case, right, let's see. Let's see. So if on April 20th, right, my original purchase was I purchased 200 units at $6 each. That means 1,200 is my number that I originally purchased, right? That means $20 is free. So that means I'm looking at 1,200. But I end up getting a discount right here because I end up trying to return 25 units, but they end up giving me a discount instead. So that means I got to take that 1,200 minus 30, so I'm left with 1,170. So what is my discount now off of 1,170?
$1,111.50.
Is that including the freight?
No. So I took 1,200 minus 30.
1,200 minus 30.
95%.
Okay,
Is
so
the balance.
so that's your okay. I see what you did. So there you go. So 1,200, okay, minus the 30, right, will give you 1,170, and you multiply that by 95. So that's how much you're gonna pay, right? Don't forget the freight. What about the freight?
Yeah, and then plus we pay 20, and I add the $20 to it.
Okay, so in grand total,
So the total bill.
so in this case, how much did you pay in grand total?
1,131.50. $1,131.50.
Good. So that means how much are you going to discount?
$58.50.
Good. Okay. So you could do it this way, right? Or you could take your 1,170 times 5%, got your discount for 58.50, and then solve for how much you're going to actually pay. So in this case, I may owe 1,190, but because they gave me a discount, I'm only going to pay 1,131.50. Okay? And now this time I'm going to recognize, right? Payment for purchases for purchase made on April 20th. Okay? And I'm going to actually recognize that I received 5% discount. Okay? And I wrote check number 3. Okay? Good. So, again, let's go ahead and do the last one here. Okay? Let me add some more here. So in this case, right, let's go ahead and recognize that last one. So the last thing I had here was I end up purchasing my last purchase on April 25th. If I'm making a payment on April 30th, I for sure guaranteed, right, that's only 5 days later, I for sure guaranteed I am going to be receiving that 5% discount. So in this case, right, since there's nothing that went wrong with this purchase, right, all I did was purchase my 500 units at $6.25 each. So what is my grand total discount here going to be if I recognized that I purchased 500 units at $6.25 each? Okay, so I'm going to recognize pretty much the same thing, only difference is the numbers I'm using are going to be different.
pay your discount, the inventory is $31.25.
Okay, good. So what's 5% of 31.25? Okay, so 3125 multiplied by 5% or 0.05, I should get
15625.
156.25. How much do I actually owe? What did I originally record that I owed?
$31.75.
31.75. So if I owed 31.75 and I discounted by 156.25, how much am I actually going to pay?
$3,018.75.
Good. All right. Excellent. Okay. So that is it for the first section of chapter 7.